Deal Surgeons, Elite Masterminds, what's going on? This is Diamond Life, and I'm doing a review of natural gas. Let me actually go to the 5 minute chart for New York Open. Okay. So let me show you what happened. So I want you to take a look at the structure here. So if you understand ICT, which is superior PhD level of market structure, I believe. The only thing that I'm going to show in this video is supply and demand. It actually works, even though ICT talks down on it big time. And I didn't want to deal with it for a long time because he talked down on it, and I'm definitely part of the ICT culture big time. But it actually works, and I want to show it here, especially on natural gas. It's kind of crazy. Let me lighten this up a little bit. Okay, so right here people who understand ICT, we are more dangerous than these supply and demand people. Then it's all they know. Because I see people charts and everything, and they don't understand why price is reversing. I'm like, it's a mitigation block. What are you talking about? But all they know is supply and demand, and that's it. So I understand the structure. So here's a bearish mitigation block. Now we have one right here as well, bearish mitigation, okay? But price is going to respect the higher one, okay? And so what we have here is this is before 9:30, okay? Pull the chart over a little bit. I'm on the 5 minute chart now. I also have some indicators on here because this is scalping. Okay, now ICT also talked down on the indicators, but I was watching a guy named Trader SG, and he was saying if that's what you want to use, I don't have to use indicators. I just been experimenting with it with scalping. Okay, so it was just kind of fun to use. I just started doing this. I've been coming up on almost 3 years, in the game here. So, once you understand the structure, you can start using indicators if you choose to, but it's not. A lot of you people start off with indicators, which is unfortunate. So here's the bearish mitigation block, mitigation in the lower one and the higher one. Now, before 9:30, this box right here, I'm going to show you where I got in at. Before 9:30, we had a supply demand zone down here. Okay. It's not the best demand zone because usually we want to see a gap on the first candle here, but it's on the third one. So it's not the best demand zone. So I knew or kind of thought price probably wouldn't take it. So I said, well, what's most likely to happen? Right here, we have a EMA, and usually price will go down wherever, if this price was not touching this EMA right here, okay, and then I would see price would push down to this demand zone right here. Okay, but since it was touching it and it closed above it, I said, you know what? Price is going higher right at 9:30. Okay, I said price is going to go higher at 9:30. Now, this line right here is exactly 9:30. So I looked up and I said, okay, well, if it's going higher, also we had another indicator that I use, which is more of artificial intelligence type of thing. I want more of it's an advanced, I just say it's an advanced indicator. Before on the 5 minute chart, I always look on the 30 minute chart, 15 minute and the 5 minute and see what the arrow is pointing towards, okay? And all of them were pointing up. So I'm like, okay, well, it's going to push up, but to where? See, this is where supply and demand people don't understand. They just do a break of a candle, and I'm just going to do a 2 to 1 or 2 to 5, 3 to 1 or whatever. But I understand the structure, so I'm like, okay, well, what we have over here, the only reason it's going to want to go higher is to one of these mitigation blocks here. It's either going to go up to this one, but most likely, understanding the structure, it's probably going to stop at this one. So that's what I did. We went ahead and went long at the open, 9:30. Now remember, we had a demand zone down here, but I'm like, it's not going to come down there because on the 15 minute, this is a 5 minute. So on the 30 minute, it was up. 15 minute was up. Green arrow. On the 5 minute, it's up. Yes, we're below this EMA right here, but it is touching the EMA and it closed above it, which is important. So I said it has to go higher. So I went ahead and went long. Actually, I went long right here on it. I kind of like to go long or short sometimes right before 9:30. 9:25, I went long right here. So I was in drawdown here. So let's see what happened here. Move to the right. Pushing up. Pushing down. I still held. Stop loss was down here below this swing low. right there. Okay, this trade was a 2-to-1, damn near. So I'm in drawdown because price is over here now, and I got in here. This yellow line is 930. You understand that? I still held because I knew where it had to go. I didn't believe it would come down here and take this demand zone just yet. And it just created a supply zone here, that gap. The stuff that ICT say don't work. Okay. But ICT structure is superior for sure because I knew price had to come up here. This is a bearish mitigation block. I studied this like my life depended on it. And like ICT says, once you see it, you can't unsee it. So true. So I'm still holding this long. Remember, I got in right here where you see that yellow line at. Okay. So now we see price here at this first mitigation block. I said I still was holding because I'm like, man, it has to come up to this higher one. I didn't seen this stuff too many times, but obviously you're going to see a rejection off of this candle, and boom. So it went up there, and this is where I got out at. It touched it perfectly. And then I went ahead and went short. And I said, well, where am I going short to? Down to this demand zone down here. This is the only thing that was left. This literally was the only thing that was left. Because if you look at the structure over here, we had a supply zone up here. But with natural gas, it respects supply and demand zones equally. I got this from somebody on YouTube. The guy was talking about, you know what? Let me take a look at this. He was just ranting and raving about natural gas respecting these zones. So I was like, okay, let me go short. And the stop loss was above. It was high as hell. The stop loss was pretty high. But I put it above this high right here instead of this high. I should have put it above this wick, but that was just a little bit too much. It was this stop loss was even too high. Okay. So let's go back. So went short right at that mitigation block because I understand how it works. This is a fresh bearish mitigation block. So price is going to reject hard. And so I'm like, well, where's it going to reject to? Now this is a supply zone here, a demand zone here. I thought about getting out right here at this gap. But I said, well, what happened first? This demand zone down here, this one happened first. So I should have marked this one up. I should have had a yellow shaded area here. But I said, it's probably going to come all the way down here. Didn't want to see this spike right there, but I'm still holding. Boom. So I didn't take it all the way down to that demand zone. I literally got out here. That was incorrect. I should have just held it down there because as long as this high wasn't taken, then everything was cool. But I started to see these highs start to get taken. Like this high was taken and this high was taken off this white candle. So I'm like, okay, well, it's about to reverse, or do a short pullback. So that's that one right there. That's 2-to-1. And so I just wanted to shoot this. I just thought that was pretty cool to see that using these indicators that ICT say we shouldn't use. Thanks for watching.